Good morning, everyone, and thank you for taking the time to join us for our half-year results presentation. I'm David McCreadie, and with me today is Rachel Lawrence, our Chief Financial Officer. It is only 4 months since we presented the Group's 2020 annual results at the end of March. Of course, so much has progressed across the country in that time, including the successful rollout of the government's vaccination programme and the reopening of the economy as lockdown restrictions were eased. Well, there's no doubt the pandemic continues to have an impact and we need to remain vigilant to the challenges that may present themselves. The outlook has certainly improved. You'll have seen from recent announcements that much has also been progressed at Secure Trust. As we continue to successfully navigate the crisis, we have seen business activity improve, we've disposed of our non-core portfolios in line with our strategy, and we're well positioned to take advantage of opportunities to help even more customers as the recovery continues. So let me turn to some of the key headlines from our half-one results before Rachel covers off the financial performance in more detail. I'm delighted to announce that the Group delivered an excellent first half result, with half-year statutory profits before tax of 30.7 million, a record for the half year. The six-fold increase in profit from last year's 5.1 million is predominantly driven by a reduction in impairment charges, and Rachel will go through the detail of that shortly. I would highlight, though, that this improvement is mainly down to the continued low level of arrears. In large part, this is due to the action taken in recent years to improve the risk profile of our lending, in V12 retail finance in particular. We delivered strong new business lending volumes of 625 million in the first half, an increase of 28%, and I'll show the quarter-by-quarter comparison back to Q1 2020 in a moment. I highlighted in March that as the economic recovery took hold, we would be getting back to managing risk rather than minimising it. The credit tightening measures that were introduced during Q2 last year at the peak of the uncertainty were progressively reversed out as we went through the first half of the year, and we'll benefit more fully from that during the remainder of 2021 and beyond. We also spoke in March about the low level of payment holidays outstanding in our consumer finance businesses, and I can tell you that nearly all of those arrangements had completed by the end of June, with negligible numbers of customers remaining on payment holidays. The great majority of customers who took a payment holiday have returned to full payment. Post the end of the half year, we announced the disposal of 2 non-core lending portfolios that have been in run-off for some time, mortgages and asset finance. These disposals, representing 2.7% of our lending at the end of June, are important steps in simplifying the Group and focusing our attention on the growth opportunities we see for our core businesses. Both portfolios had been closed to new business for a number of years, and so it's pleasing that these transactions completed during July and are now behind us. We also completed the closure of our legacy One Bill product during the period, and I'll touch on that later. The board has approved a new dividend policy where 25% of full-year earnings per share will be returned to shareholders. The policy reflects the board's desire to return value to shareholders while retaining sufficient capital to support the Group's ambitious growth plans. The board has recommended an interim dividend of 20p. The usual key metrics are called out on the right-hand side of the slide as well. CET1 ratio remained at 14.2%. Our net interest margin of 6.3% remained broadly stable, reflecting a mixed change as higher margin motor finance lending took longer to recover than other business lines following the last lockdown, and the continued shift to better quality, lower risk lending in V12 retail finance also impacts on that margin. Our cost of funding improved further to 1.4% from 1.9%. Our cost income ratio of 64% compares to 52.7% for half one last year. Our operating expenses increased by 6.6 million, and Rachel will show the key changes in costs between the two periods. And our return on average equity increased to 18.8% from 3%. So with the outlook continuing to improve, we're confident that we will deliver further growth in our lending. Our strategy, diversified lending portfolios, and our strong balance sheets mean we're ready to deliver our growth ambitions and medium-term targets. If I turn to our new business volumes, I can show you the details, including the breakdown of lending by new quarter. As mentioned, we delivered a 28% increase, compared to the first half of 2020 when the initial lockdown was in place. The growth in both consumer finance and business finance was 28%. New business lending in Q1, when the last lockdown was still in place, grew by 7%, and in Q2 grew by 60% over the comparable periods last year. The green bars represent new lending in our consumer finance businesses. The 256.8 million of lending in Q2 was 88% higher than prior year, with strong levels of new business in V12 retail finance and motor finance lending on a monthly basis, returning to pre-pandemic levels by the end of the half. The team at V12 Retail Finance have been successful in winning new retailer relationships recently, and as those come on stream during the second half, they will provide further momentum to our lending growth. The purple bars represent new lending in business finance. The complexity and larger ticket size of facilities here result in more volatility between the periods. The 171.8 million of new lending in the first half was 28% higher than the 134 million in the same period last year. Importantly, the pipelines within real estate finance and commercial finance, which were subdued as we entered 2021, have grown throughout the period and will benefit our new lending volumes in half two. Real estate finance's pipeline has been boosted by the positive reaction of customers to our new Greener Homes loan scheme that supports those investing in energy efficient homes or who plan to develop existing properties to make them more energy efficient. So we enter the second half in a really strong position and a platform for further growth in new lending. This next slide shows the table you've seen previously on the breakdown of our diversified portfolio. We delivered growth in all our core businesses during half one, and the first row of numbers shows the change in the period for each loan book. You'll see on the left-hand side, the loan book rows compare half one 2021 to the full year for 2020, and the other metrics compare half year 21 to half year 20. We have once again shown the non-core column towards the far right-hand side of the table, and non-core represented 2.7% of the loan book at the end of June, down from 3.9% at the end of December. As mentioned earlier, the disposal of both asset finance and mortgage portfolios were completed during July. The rest of the portfolio at the end of June was broadly split 54% in business and just over 43% in consumer. You may recall that real estate finance was the only business to grow lending balances in 2020. Balances here grew slightly during the first half, although as I've mentioned, the pipeline has now been built back up and we expect the loan book to grow at a higher rate during the rest of this year. In commercial finance, which provides invoice discounting facilities, we saw lending contract in 2020 as the trading activity of our customers reduced. We have seen 3.8% growth in half one, and again, with the pipeline picking up, expect a higher rate of growth during the rest of the year. In V12 retail finance, we saw loan book growth of 5.5%. We're well positioned to support our retail partners when their stores reopened again during Q2, as well as with their online sales, and we had started to see the return of season ticket sales by football clubs by the end of the period. In motor finance, the business most impacted by lockdowns, we saw a marginal increase in total lending balances compared to half one last year. By Q2, new lending had returned to pre-pandemic levels, and having adjusted our credit underwriting rules, we expect new lending in motor to continue to build. And finally, in debt managers, we saw 10% growth in the total book and margins also improved further. You can see the cost of risk line improved at the group level from 2.9% at the half year 2020 to a release of 0.2% for half one this year, with improvements in each of our businesses. At a group level, margins remain broadly stable. Commercial finance, motor finance and debt managers also improvements in net interest margin. Real estate's margin was flat at 3% and V12 retail finances reduced to 8.4% as the mix of lending and lower risk interest-free products continue to increase. With the higher rates of lending growth in both V12, retail finance and debt managers, and the reduction in the non-core balances, just over 2/3 of our lending at the end of the first half was secured against either property, debtors or vehicles, compared to 70% at the end of last year. I'll now hand over to Rachel to go through the financial review.
Thank you, David, and good morning, everyone. David has given you the highlights of our excellent first half performance, and I'll now step you through some further analysis of these results. I'll start with the income statement for the first half of 2021, taking the first half of 2020 as a comparator. Operating income was down by 4.7 million to 80.2 million, with both net interest income and fee and commission income down 5.6% and 4.3% respectively, reflecting the continuation of lockdowns in Q1. The net impairment release of 1.1 million compares with a charge of 31.5 million in H1 2020 as a result of the improved credit quality of the consumer division, lower volumes of motor new business, and a modest reduction in forward-looking macroeconomic indicators. Costs increased by 6.6 million in the first half to 51.3 million, reflecting continued investment, readiness for growth, and the reversal of one-off items from H1 2020. All of this together results in a profit before tax of 30.7 million, up 502% on the same period in 2020, and an 18.8% return on average equity. I'll move on now to net interest income on slide 8. Net interest income reduced by 4.4 million to 73.5 million. The main drivers of this reduction being a 3.8% reduction in the average lending balances, a 3.3% reduction in the higher yielding consumer as a percentage of the total lending balances, offset by a reduction of 52 basis points in the cost of funds. Consequently, NIM remained relatively flat at 6.3%. The gross yield impacted by the shift away from higher yielding consumer finance being materially offset by the reduction in the cost of funds. As the consumer lending balances grow in the second half of this year and into 2022, the mix impact on NIM should reduce. Now on to the next slide, fee, commission and other income. Net fee and commission income reduced by 0.3 million to 6.7 million. The closure of one bill resulted in a reduction of 1.5 million in the first half. However, both the consumer and business divisions delivered increases in fee and commission income in the period of 0.6 million and 0.8 million respectively, reflecting increased new business volumes. I'll move now to operating expenses. Operating expenses increased by 6.6 million to 51.3 million for the first half. The main drivers of this increase are employee costs, which increased by 1.3 million as a result of dual rolling on a number of senior roles, level of bonus accrual, offset by lower average headcount. We continue to invest in our IT infrastructure and the motor transformation programme, increasing costs by 1 million. New strategies to improve collections performance in DMS drove a 2.3 million increase in legal costs, and there was no benefit of the one-off VAT recovery from H1 2020. As indicated at the annual results, our growth strategy will result in increases to absolute operating expenses and the associated cost-to-income ratio for a period of time. As the balance sheet grows, the additional income, coupled with cost discipline, will reverse this trend. Now moving on to ECL and macroeconomic indicators and weightings on the next couple of slides. We have reviewed the macroeconomic scenarios in terms of weightings and the key indicators of unemployment and HPI, given the improving economic environment, which has resulted in some modest revisions. Weightings in the severe scenario have been reduced to 5% from 10%, with the offset in the base case medium scenario. A reduction in the peak unemployment rate in all scenarios except severe of 1% results in a still prudent weighted average peak unemployment rate of 7.2%. Our HPI peak to troughs have been reduced to reflect the current house price environment. The peaks of these indicators have also been shifted out by 6 months to reflect the extension to furlough and other government schemes. You will see the sensitivities on this slide indicating 100% weighting to the severe scenario increases the impairment charge by 13.1 million, and if weighted 100% to the upside scenario, reduction in the impairment charge of 5.2 million. On to slide 12 on the impairment release. Overall, the impairment release for the half year is 1.1 million. It is a decrease of 32.6 million on the same period in H1 2020. The continued low arrears position, the shifts to better credit quality assets, and lower volumes of motor new business drove the majority of this decrease. The changes in macroeconomic indicators and weightings reduced provision levels by 2.7 million. Coverage ratios remain prudent at 3.1%, a decrease of 0.3% to year-end 2020, but still elevated to the full year 2019 ratio of 2.4%. The impact on cost of risk is a decrease of 3.1% to minus 0.2% for the half year. Now moving on to the balance sheet on slide 13, with the year-end 2020 as the comparator. At a summary level, the balance sheet remains steady, with total assets reducing by 1%. Loans and advances increased by 1.3% and excluding the non-core divisions by 2.6%. Total funding remained steady, with customer deposits contracting by 2.6%, but offset by an increase in TFSME drawings, and shareholders' equity increased by 6.7% to 288.7 million. Now on to lending balances and new business on slide 14. Firstly, loans and advances increased by 31 million in the first half of the year. All core divisions returned to growth, with retail finance being a significant contributor to this growth, as retail reopened in April and season ticket loans restarted. Non-core divisions reduced by 27.3 million, and with both asset finance and consumer mortgage sales completing in July 2021, the drag on the lending balance will reverse in the second half of 2021. From a new business perspective, we have seen a continuation of the positive performance in Q4 2020, with a 28% increase when compared to H1 2020. Retail finance delivered a 35% increase in new business volumes in Q2 2021 when compared with the pre-pandemic Q1 2020, and motor was also up 4% with the same comparison. Now on to funding and capital in the next couple of slides. Total funding remained static to the 2020 year-end position. We have continued to actively manage our funding position away from the more expensive fixed-term deposits, delivering a further reduction of 3.9%. This reduction and our focus on attracting ISA and notice accounts has reduced the cost of funding at the half year to 1.4% from 1.9% from the same period in 2020. Our TFSME drawings increased by 30 million in the period, and we plan to continue to replace TFS balances as they mature with TFSME. On to capital on slide 16. Our capital position is strong and has improved during the half year as a result of the increased profits. RWAs increased by 63.5 million as a result of the growth in lending balances. CET1 ratio remains static at 14.2%, driven by the interim net profits contributing 130 basis points, but offset by the reduction in IFRS 9 transitional relief, both quick fix and the original relief, consuming 60 basis points, and with the proposed dividends and increases in RWAs consuming 70 basis points. Total capital ratio at 16.5% provides a strong position for growth. Thank you, and I'll pass back to David so he can give you an update on the strategy and outlook.
Thank you, Rachel. I'll just take a few minutes now to make some comments on our strategic priorities and the outlook. I've deliberately used a similar slide to the one I used in March to make it clear that we remain committed to continuing with our existing strategy, although we will be evolving and freshening up our articulation of the strategy. As I said then, we'll continue with the priorities on the left-hand side of this slide, which reflect our distinct strengths and the opportunities we see ahead of us. Let me turn, though, to the right-hand side of the slide and some of the commitments I made to evolve the group. In recent months, we've been working diligently to consider and define our core purpose. It is important that our colleagues, customers, and other external stakeholders know what we stand for and why we exist. The work we've progressed so far is now being refined internally, and I look forward to sharing that with you at the Capital Markets Day later in the year. I also set out my intention to simplify the group. We've moved quickly this year to make decisions on our non-core products and to complete the disposal of the mortgage portfolio and asset finance portfolio. These are really important steps and signals of our commitment to become a simpler and more focused organisation that's determined to deliver further levels of growth. The closure of all accounts within our legacy One Bill product was also completed during the first half. As well as managing the closure of accounts for many long-standing customers, we also saw a number of long-serving colleagues leave the business. I would like to thank them for the professionalism they continue to show in supporting customers through the closure process, as they had done over many years previously. Simplifying the group will allow us to become more efficient as we move forward, and as you know, we set out in March a medium-term target to achieve a cost-income ratio in the 50 to 55% range. Rachel has shown the cost drivers that led to an increased cost-income ratio in the first half, and the raised level will also be a feature of the full year. We have been reviewing the detailed drivers of our cost base and are developing plans to manage our expenses more effectively so that they can contain expenses growth as we continue to grow the lending side of the business. Improving the cost-income ratio also requires us to scale our businesses. The momentum in new lending is certainly building, evidenced by the 28% growth in half one that will generate future income for the group. Our primary focus remains on scaling our business organically, although we remain open to any inorganic opportunities that we feel are in line with our strategy and are value accretive. We'll share more of our plans at the Capital Markets Day, which we plan to hold face-to-face in London on the 3rd of November. If for any reason it is not possible to meet face-to-face, then we would hold a virtual event on the same day. This next slide sets out our half one actual results against our medium-term targets that we shared with you in March for 4 key measures. As you can see, in the first half, 3 of the 4 measures exceeded our medium-term targets. The only measure that did not is the cost-income ratio that we've already discussed, and we do remain committed to the 50 to 55% range. Finally, let me make a few short comments on the outlook for the group. We're clearly seeing evidence of the recovery coming through, although there may be some further challenges to navigate. The economic outlook and confidence has improved, activity is increasing, and our lending volumes will continue to benefit as a result. The group's diversified business model has continued to be a key strength. We were able to react with agility last year in responding to the pandemic and supporting existing customers. We've been equally agile in preparing to grasp the opportunities as market conditions improve. We delivered strong new business levels across business finance and consumer finance in the first half and expect to deliver more significant growth in total lending by the end of the year. The board has agreed a new dividend policy that reflects confidence in the group and our ability to invest for further profitable growth. The new policy provides clarity on the consistent level of earnings to be returned to shareholders. So we're really well positioned and our capital and liquidity positions remain strong. We're ready to deliver our growth ambitions to create further shareholder value and are confident in achieving all our medium-term targets. That brings this section of the presentation to a close, and we'd be happy to take any questions that you may have. Thank you.
If you would like to ask a question, please signal by pressing *1 on your telephone keypad. If you are using a speakerphone, please make sure your mute function is turned off to allow your signal to reach our equipment. Once again, press *1 to ask a question. We'll pause for just a moment to allow everyone an opportunity to signal for questions. We can now take the first question from Gary Greenwood from Shore Capital.
Good morning. Thanks for taking my questions. I've got three, if I can. So the first one is on funding costs, which have obviously been a real positive story in recent times. So I'm just wondering what scope there is to further reduce funding costs, how much benefit you've still got to come through from mix effects there. Then the second one is on costs. Obviously, there's quite a bit of cost inflation in the first half of the year. So just how we should think about that in terms of the full year, and then more importantly, I guess, the trajectory on cost growth thereafter. And then the last one is on your impairment and provisioning assumptions. So I note your weighted average unemployment assumption is still a peak of 7.2%, which I think is quite high relative to what the Bank of England's thinking the peak might be now. So I'm just wondering, is that a reflection of the mixture of your customer base, or is that just a case of trying to keep a good degree of conservatism in the numbers for the time being? Thank you.
Thanks, Gary. I'll let Rachel pick up on each of those.
Yeah, okay. Gary, yes, funding costs, scope to reduce. I think there is some more scope, but it won't be as aggressive probably as what you've seen in the 1.9 down to the 1.4. There will be a plateau area where we will not consider doing any more mix changes to protect the book from a perspective of having term on it. So yes, there is a little bit, but I wouldn't expect to see the kinds of levels of reductions we've seen over the last year. On costs, I think in terms of, we indicated at the annual results that obviously 2020 was a interesting year for lots of reasons, but the costs were obviously suppressed because of the lack of volume, and we will see volume coming back onto the balance sheet in H2. So you'll see some more cost inflation, I would say, in H2 in comparison to H1. Our cost base, we will be leveraging it in the future years, but we will see income driving most of our cost to income ratio reductions rather than absolute costs. As David mentioned, we have a programme that we've started to look at efficiencies. Simplicity is a key part of what we're looking at for the group to ensure that we keep that cost base to the lowest level we can, while we still can drive the revenue in terms of improving that cost income ratio. On impairment, yes, you're correct. The 7.2% is probably on the conservative side. We took the anchor point of the Bank of England's May MPC report, and that had seen a 1% reduction. So that is what we kind of looked at and decided that that was an appropriate level of reduction. We will continue to monitor that, and obviously there's a report that comes out today, I believe, so we'll keep a good watchful eye on that. But there may be some scope in the second half to revise those, seeing what we can see in terms of those economic forecasts that come out.
That's great. Thanks very much for answering the questions.
Thanks, Gary.
Once again, if you would like to ask a question, please press *1. We can now take the next question from Robert Sage from Peel Hunt.
Yes, thank you much. Thank you very much for the presentation. I've got a follow-on question on costs, actually, which I guess comes in two parts. The first one is, you've pulled out some specific investment programs, which have been one reason why your costs have been going up in the first half of the year. And I was wondering, in terms of where we are now in your total group investment program, was this a sort of a high watermark in terms of where we are, or should we expect to see similar levels of investment? Might it even increase in coming years? Just to sort of get a feel in terms of how much of this increase is due to the investment program. And the second question on costs is that I note that you have not changed your medium-term cost-income ratio at 50 to 55%. That's obviously a long way below where it was running in the first half, and you've signalled cost inflation for the second half. And I was wondering how we should think about the sort of the medium-term timetable for this. It seems improbable that it's actually going to get down into the range in, say, 2022, but Might it come as early as 23, or should we be sort of thinking in terms of slightly longer term than that?
Yeah, I'll pick those up, Rachel. On the second one first, Robert, and thanks for your questions. The medium term that we were, I think we gave an indication of when we gave those medium term targets in March was actually 3 years. So you're talking about 2023 financial year. So you're right, it's not 2022. We would see the cost income in particular come back down to the levels of that range, but 2023 is what we're targeting. And on the investment programme, listen, most of this is down to finishing the job on the motor transformation piece. So most of that investment, as we said again in March, is behind us. Low single-digit millions to come, and part of that is what you saw come through in the waterfall chart that Rachel showed earlier.
Thank you very much.
Thanks, Robert.
Once again, if you would like to ask a question, please press *1 now. At this time, there are no further questions. I would like to now hand the call back over to David McCreadie for any additional or closing remarks.
Okay, well, thank you, and thanks for those questions to Robert and Gary. Just a few, closing comments from me, really. Just in summary, obviously we delivered a very positive and strong profit number for the first half at a record level, albeit a lot of that driven by the impairment, as Rachel has explained. New lending has increased by 28%, so momentum is building. The board has approved a new dividend policy, and that targeting 25% earnings per share being returned to shareholders is really a signal of the confidence that the board has in our organic growth plan. And hopefully the clarity and giving you a line of sight of that is helpful. We've taken steps to simplify the group, as we've already mentioned, closing off a number of products a number of years ago. Now actually getting them off the books is helpful in simplifying the number of businesses we have to manage and focusing management's attention for the greatest opportunities still ahead of us. And this momentum that we're building, we see continuing into H2 and beyond. We're looking forward with optimism, very ambitious plans that we have for organic growth, and obviously we would look to share more of that insight with you that we see at the Capital Markets Day in November. Hopefully we'll be able to do that face to face, and look forward to introducing more of the management team to you there and allowing us to spend a bit more time getting into the details of our business lines and the market position and the outlook for each of them. So hopefully this morning's session's been helpful. I know we'll be talking to a number of you again, either later today or in the coming days. We'll look forward to that. But if not, we'll talk to you again later in the year. But thanks for joining.